What are the biggest accounts payable fraud cases? Imagine losing millions of dollars because of a simple mistake or a sneaky scam. That's what happens in some of the largest accounts payable fraud cases in history. These cases show how fraudsters use different tricks to steal from companies, often by pretending to be vendors or creating fake invoices. One of the most famous cases involved Google and Facebook. Between 2013 and 2015, a Lithuanian man impersonated a real supplier called Quanta Computer. He set up fake companies and bank accounts in Cyprus and Latvia. Then he sent fake invoices to Google and Facebook's accounts payable departments. Because their processes didn't verify vendor details properly, employees paid over $100 million to his accounts. The money was then laundered through multiple countries, making it hard to trace. This case highlights how weak verification can open the door for fraud. Another big case happened at Polar Rig Specialties in Texas. An employee used the company's accounting software, QuickBooks, to divert nearly $800,000 for personal expenses. She disguised these payments as vendor bills, taking advantage of internal control gaps. She continued this scheme for several years, causing serious financial damage and harming the company's reputation. This shows how internal controls and segregation of duties are vital in managing accounts payable. A different type of fraud involved a former IT executive at Naked Security. He created a fake shell company and generated fraudulent invoices for years. Payments were made directly into his bank account until forensic analysis uncovered the scam. This case demonstrates how internal employees with knowledge of the system can exploit their access to commit fraud. It reminds us that regular audits and monitoring are essential. There's also the case of A1 Janitorial, which used a clever external scheme. They sent invoices for cleaning products after giving free samples to businesses. The invoices named specific employees to make them seem legitimate. Many companies paid for unordered products or repeated bills, losing money in the process. This type of fraud shows how external schemes can trick even cautious companies. While primarily an accounting fraud, the Health South case involved falsified financial records, including inflating expenses and revenues. This affected their accounts payable process because false expenses were recorded and fake invoices might have been paid. The CEO's involvement shows how high-level manipulation can impact the entire financial system. The Wirecard scandal was massive, involving around 1.9 billion euros. The German payment processor inflated profits by creating fake contracts and revenue streams through third-party partners. Although broader than just accounts payable, it involved fake vendor transactions and payments, leading to the company's collapse and criminal charges. This case underscores the importance of thorough verification of vendor relationships and transactions. These cases share common themes. They involve false invoices, impersonation, or fake companies. Fraudsters often exploit weak verification, lack of segregation of duties, or insufficient oversight. To prevent these issues, companies should verify vendor identities and bank details before payments. Segregating invoice approval from payment processing helps catch suspicious activity. Regular audits and forensic reviews can spot irregularities early. Training employees to recognize phishing and invoice scams is also key. Using secure electronic invoicing systems with authentication adds extra protection. Managing accounts payable with strong controls not only saves money but also keeps your company safe from fraud. It ensures your financial reports are accurate and your business stays compliant with tax rules. Staying vigilant and following best practices can help avoid falling victim to these costly scams.